Welcome to the Opening Bell Report.
Imagine for a second that you own a business. And not just any business. You are absolutely crushing it.
Okay, I like where this is going.
Right. You just had the best year of your life. I'm talking about doubling your revenue, paying off all your debts, and finally, after years of, burning cash, you are wildly profitable.
Dream scenario.
Exactly. You essentially ace your report card. So you walk into the shareholder meeting to show off these results, chest out, expecting a standing ovation, and instead...
Let me guess.
Everyone screams, panics, and runs for the exits. They start selling their stakes in your company, and your value drops by a quarter overnight.
Yeah, it sounds like a glitch in the Matrix, honestly, or just a complete nightmare. But that is exactly what happened in the real world recently.
It really is a baffling contradiction. So today, we are unpacking a story that is less about financial spreadsheets and more about a massive disconnect between market psychology and business reality. We are looking at Astera Labs, ticker symbol ALAB.
Right. And specifically, we're diving into an analysis report that suggests this crash might be one of the biggest overreactions we've seen in the II sector all year.
The mission for this deep dive is pretty clear. We need to figure out why Wall Street is panicking, why this analysis report says they are completely wrong, and how there might be a hidden 58% upside sitting right there in plain sight.
It's a classic case of the market missing the forest for the trees.
Yeah.
Or, to use a metaphor we'll come back to later, missing the diamond mine because they're worried about the cost of the shovels.
I love that analogy. Okay, so let's unpack this. We have to start with the wall-to-wall celebration metrics mentioned in the report. Because if you just look at the headline numbers without looking at the stock price, you'd assume the stock would be shooting to the moon.
Absolutely.
Yeah.
The disconnect here is it's startling. Let's look at the fiscal year 2025 revenue. Astera Labs hit $852.5 million.
And for context, for you listening, that is not a small bump. That is a 115% increase year over year. They more than doubled their money.
Exactly. And in the hardware world, sustaining triple-digit growth like that is incredibly rare. But the even bigger story, and this is what usually makes institutional investors drool, is the profitability flip.
Right, because for a long time, Astera was in that typical cash-burning startup phase.
Yeah. In 2024, they lost $83 million.
Which is standard for high-growth tech. You burn cash to grow. That's the whole Silicon Valley playbook.
It is. But they graduated. In 2025, they didn't just break even. They posted a net profit of $219.1 million. That is a massive swing.
So they went from losing $80 million to making over $200 million. That's a nearly $300 million turnaround in profitability in 1 year. That is enormous.
Precisely. They have officially transitioned from a speculative startup to a highly profitable enterprise. The fundamentals suggest this company is firing on all cylinders. They aren't just promising to make money someday. They're printing it right now.
Okay, so here is the question that I think everyone listening is screaming at their device right now. If they are making hundreds of millions in profit and growing at triple-digit rates, why did everyone sell?
It was brutal. The stock plummeted 24% almost instantly. It sliced all the way down to the $128 level.
And looking at the charts, that means it's currently trading about 51% below its all-time highs. It's essentially on a half-price sale compared to its peak.
It is. And to understand why, we have to get inside the head of a Wall Street trader. And unfortunately, that place is often dominated by extreme short-termism and a deeply ingrained fear of peak margins.
So what was the specific flaw they found in this perfect report card? What spooked them? Did the CEO insult someone on the earnings call or something?
No, nothing like that. It was 2 data points. And when you hear them, they might sound incredibly minor compared to the growth we just discussed. First, there was a tiny contraction in gross margins. We are talking about 70 basis points.
70 basis points? Wait, that's 0.7%?
Correct. It's a rounding error for most businesses.
That's insane.
It is. But you have to understand the narrative around hardware stocks. There's always a fear of commoditization. The idea that eventually your fancy chip becomes just a generic part and your pricing power disappears.
So when the trading algorithm sees the margin go down, even by 0.7%, it just assumes the glory days are over.
Exactly. It flashes a red warning light. And that fear was compounded by the second factor, which was a guidance on operating expenses, or OPEX.
Right.
The company said their costs would rise to between $112 and $118 million in Q1 of 2026.
Okay, so let me get this straight. The market logic is, oh no, their margins shrank by less than 1%, and they are planning to spend more money next quarter, sell everything.
That is essentially the logic.
Oh.
The market saw rising costs and slightly tighter margins and immediately punished the stock. They interpreted spending money as losing discipline. They looked at the expense column and panicked.
But wait a minute, this drives me crazy. Astera Labs is a hardware company. They make the physical chips and connectivity switches that go into data centers.
Yes, they do.
So isn't punishing a hardware company for spending money on hardware completely counterintuitive? If you want to sell more chips, you have to spend money to make them. You can't just wish them into existence.
That is the aha moment the analysis report points out. It frames this as a textbook overreaction. The market is reacting to the cost of doing business without looking at what that business actually is.
Right.
They see a number in the expense column and panic instead of seeing it as an investment in the future revenue column.
It's like getting mad at a baker for buying more flour when he has double the orders coming in.
That is a perfect analogy. And in the semiconductor space, specifically in AI data center connectivity, you cannot afford to coast. If you stop buying flour, or in this case, if you stop building capacity and researching the next chip, you die. The technology just moves too fast.
So let's look at where that cash is actually going, because
Right.
the report says this isn't waste, it's structural investment. What does that mean in plain English?
It means they are building the foundation to support that massive growth we talked about. The analysis details exactly where the money is going. A big chunk is going into R&D, research and development. Specifically, they're funding a massive new R&D center in Israel.
Israel is a huge hub for semiconductor talent, isn't it?
It is. A lot of the major breakthroughs in silicon come out of that region. So Astera is hiring top-tier talent. And secondly, they are ramping up physical production, like really scaling up for something called Scorpio fabric switches.
Scorpio fabric switches. That sounds like something out of a sci-fi movie. But I assume these are important.
Vital. And this brings us to the context of the competition. We really have to talk about the AI arms race. You have the hyperscalers, companies like Amazon, Google, and Microsoft.
The absolute giants.
Right. They are locked in a race to build the fastest, most powerful AI models. And to do that, they are building data centers that are essentially one giant computer. They string together tens of thousands of GPUs, mostly from NVIDIA, and try to make them act like a single brain.
Okay, so imagine thousands of chips trying to think the exact same thought at the exact same time.
Exactly. But here's the problem. Physics? If those GPUs can't talk to each other fast enough, you get a data bottleneck. The data gets stuck in traffic between the chips.
It's like having a Ferrari engine but sticking it in rush hour traffic. It doesn't matter how fast the engine is if the road is clogged.
That is the perfect visualization. And Astera Labs provides the open road. Their primary product for a long time was something called ARES. These are smart retimers. Think of them as signal boosters you place along the motherboard to keep the data signal strong and clean.
So Ares is the signal booster. What is Scorpio?
Scorpio is the next level up. It's a switch. If Ares is the signal booster on the highway, Scorpio is a high-speed interchange that directs traffic between thousands of different highways. It allows the GPUs to talk to other GPUs in different server racks at incredible speeds.
And the report mentions they have a total monopoly in this area. That is a strong word to use in tech.
It is, but the report backs it up. This is based on the PCIe 6 connectivity standard. It's the new speed limit for data centers. It is incredibly fast, but also incredibly difficult to engineer for because the signal degrades so easily at those speeds.
So it's just physically hard to do.
Extremely. And right now, Astera Labs is the main player with a working, deployable solution in this specific niche. The hyperscalers, Amazon, Google, Microsoft, they need Astera solutions to prevent those bottlenecks. They can't just use a generic cable.
So when Astera spends money on that R&D center in Israel or ramps up production of Scorpio switches, they aren't just spending for the sake of spending.
No, they are building a moat.
A defensive moat.
Precisely. They're outspending any potential competitors now. Companies like Broadcom or Marvell who really want to be in this space to ensure that when the next generation of AI racks are built, Astera remains the only viable option for connectivity.
So if I understand the thesis from the report correctly, the market punished them for spending money to make sure they keep their monopoly.
That is the irony. They are paying to cement their dominance so no one else can catch up. And the market saw that bill and completely freaked out.
Which brings us to the opportunity. Because if the market is wrong and the company is right, there has to be a valuation gap. The report mentions a 58% upside. Where does that specific number come from?
It comes from the difference between the retail panic and the institutional view. While regular traders and algorithms were selling off the stock, Wall Street analysts, the ones who write the deep, detailed reports, haven't flinched.
They didn't downgrade the stock at all.
No. In fact, the consensus is quite bullish. The average price target is still firmly parked at $204.47.
Okay, let me do the math. The stock is bouncing around that $128 consolidation zone right now. So getting back to $204
is a 58% jump.
Exactly.
That is significant. But let's play devil's advocate here for a second. I know we love a good market is wrong story, but sometimes stocks drop because they were just too expensive to begin with. We hear about PE ratios all the time in tech. Was Astera just overpriced? Was it a bubble popping?
That's a great point, and it's one we definitely have to address. Let's look at the PE, the price-to-earnings ratio. Before this crash, Astra's trailing PE was over 200. That is very high. It means investors were paying $200 for every dollar of earnings.
Ouch. Yeah, that is pricey. That's what they call price for perfection.
It is. But look at what happened after this report. Two things happened simultaneously. The price dropped by 24%, and the earnings skyrocketed. Remember that $219 million profit.
Right. The E and PE got much, much bigger. So the ratio collapsed. The trailing PE dropped to roughly 100. It essentially got cut in half.
That's still high, though, isn't it? A PE of 100.
In a vacuum, yes. But you have to look at the forward PE, what we expect them to earn next year. Because their growth rate is so high, the forward PE is sitting near 50.
So this is what they call multiple compression in finance.
Exactly. And usually, multiple compression happens because the stock price crashes and the company's doing poorly. But here, the multiple compressed because the earnings finally arrived in a big way. The E actually showed up.
So it's become fundamentally cheaper, not just because the price is down, but because the business is actually making the money to back it up.
Right. And you have to look at the PEG ratio, price earnings to growth. For a company growing revenue at 115%, a forward PE of 50 is actually quite attractive to growth investors.
How does that compare to their neighbors, though? Because the report mentions Marvell, ticker MRVL. They are a big player in chips. I know a lot of people own Marvell. Why wouldn't you just buy them? They seem safer.
Marvell is a great company, and they trade at a lower multiple, around 28 times earnings. So on paper, Marvell looks cheaper.
Right. I'd rather pay 28 times earnings than 50 times.
But you have to look at what you are actually buying. Marvell is a massive conglomerate. They have AI chips, yes, but they are weighed down by what the report calls legacy, slow-growing business segments. They sell chips for old enterprise storage, consumer electronics, things that just aren't growing fast.
So it's like buying a cable package versus buying a Netflix subscription. With the cable package, you're paying for a lot of channels you don't watch and that are actively losing viewers.
That's a very fair way to put it. Astera is described in the report as a pure-play, hyper-growth AI connectivity stock. You don't have the legacy baggage. The argument is that you pay a premium, that 50 times multiple, because you want that pure 115% growth. You're paying for the speed.
And the dominance in that specific AI niche.
Correct. It all comes back to the picks and shovel strategy.
I love that analogy. I think the report breaks it down really well. It's from the old gold rush, right?
It is. During the gold rush, the people who consistently got rich weren't necessarily the ones digging for gold, because that's risky. You might dig a hole and find absolutely nothing.
Or you might find gold, but spend more mining it than it's actually worth.
Exactly. But the people selling the picks and shovels to the miners, they made money no matter who found gold.
And in this case, the gold is generative AI. The miners are Amazon, Google, and Microsoft, who are out there spending billions to find the next big model.
And Astera Labs is selling the shovels. They are selling the connectivity required to make the infrastructure work. You literally cannot build these massive AI gold mines, these data centers, without the connectivity Astera provides. Whether Google wins or Microsoft wins, they both need Astera switches to make their computers run.
That's an incredibly compelling spot to be in. So let's wrap this up and summarize the situation for everyone listening. We have a company that is pivotal to the entire AI build-out. They just delivered a quarter where they doubled revenue and swung to a massive profit.
Correct.
But because they decided to spend money to build a new R&D center in Israel and ramp up production of these Scorpio switches to defend their monopoly, their margins dipped by 0.7%.
And the market algorithm saw margin dip and spending increase and blindly decided to put the stock on the clearance rack.
Which brings us to the verdict in the analysis report. It concludes that the current support level between $125 and $130 is a highly attractive entry point.
But, and this is a big but, only if you are willing to ignore a single quarter of R&D expansion.
Exactly. You have to have a time horizon longer than 3 months. If you do, the report suggests you're buying a monopoly player at a 50% discount from its highs.
It really is a fascinating case study. It forces you to ask what you actually believe in. Do you believe in the daily mood swings of the market or the long-term mechanics of the business?
And that raises the most important question for you to consider as we close out. We often talk about the risk of buying a stock that drops. That's the fear everyone feels. We stare at the red numbers in our portfolio and feel bad.
The fear of loss is a powerful drug.
But in a market obsessed with next quarter's margins, is the real risk owning the stock that crashed? Or is the real risk missing out on the company that holds the literal keys to the data centers of the future?
That is a very provocative thought to leave us with. Are you looking at the cost of the shovel or the gold it can dig up?
Precisely. Well, that is all the time we have for this deep dive into Astera Labs. It's certainly given me a lot to think about regarding how I read those earnings reports. It makes you want to look at the footnotes a little closer.
Always look past the headline reaction. The truth is usually hidden in the OpEx.
Thanks for listening, everyone. We'll catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.